Welcome to The Explainer. Today, we're uncovering a mystery that's just kind of hiding in plain sight. We're talking about the invisible finish line of personal finance. We're going to map out the exact moment, the literal tipping point, where your money starts working harder than you do. Because, as you'll see, once your portfolio hits a specific number, saving more barely matters.
Okay, let's dive right into this. For most of us, early investing feels like this heroic, sweaty grind. You're depriving yourself, you're treating every single dollar like it's load-bearing. But there's a night somewhere in your investing life when you look at your account and without getting a raise, without some genius stock pick, the market quietly hands you more than your best month of saving ever could. While you were asleep, the money itself just took over the heavy lifting. But the cruel twist, most people miss this night entirely.
Section 1. The Big Reveal.
So, when exactly does the game change hands from you to the market? Well, it happens at what's called the crossover point. This is the exact threshold where your investments actually earn more in a single year than you put in. Below this point, your savings are doing the vast majority of the work. You're building the base. But above this point, the market takes over the job and it never gives it back.
So here's how you actually find your own personal crossover point. It's just simple math. You take what you put in every year and divide it by a 7% average long-term return. So let's say you're a solid saver putting away $12,000 a year. Dividing that by 7% gives you roughly $171,000. At that portfolio size, a normal market year throws off more than 12 grand all on its own. Now, if you are really going for it, maxing out your retirement accounts at $23,500 or even $30,000 a year, your crossover climbs exponentially, landing somewhere between $336,000 and $429,000. So it scales dramatically depending on how hard you're saving.
So the crucial point here is, if there's one single magic number for the average committed saver to just tattoo on the inside of their eyelids, it's $400,000. In that neighborhood, one ordinary year of market return starts quietly beating one full year of your absolute best saving effort.
And man, it doesn't stop there, it accelerates. Once the market is doing the work, the pile it's working on just keeps getting bigger. By the time you hit $1 million, a standard 7% return yields $70,000 a year. Just let that sink in for a second. 70 grand is more than double the absolute most you can legally cram into your retirement accounts. Your maxed out ramen noodle, zero vacation saving effort, it's literally a rounding error compared to what the portfolio is doing on autopilot.
Section 2. The Parable of Maria and Alan.
And this brilliantly illustrates the psychological weight of all this. Let's look at two 35-year-old savers. They both hit their crossover point at the exact same time, but they make vastly different choices. Alan understands the math. He sees his portfolio just hit $400,000, realizes the market is out-earning him now, and so he eases off. He stops treating every dollar like a moral failure, he takes the trips, and he just lets the machine run. Maria, on the other hand, well, she misses the invisible finish line completely. She keeps grinding, declines $300 flights to weddings, and anxiously checks her banking app every single morning like her money might have betrayed her in the night.
Section 3. Coast Fire. Compounding in reverse.
Now, you might be wondering, what if you aren't 35 with 400 grand in the bank? Well, the early retirement community has this gorgeous, simple concept for personalizing this crossover number based on your current age. It's called Coast Fire. Think of it as the crossover point wearing a nicer suit. It's essentially the amount you need invested today so that without adding another single dollar, it grows into a full retirement nest egg by age 65. You're just running the compounding math backwards from your target. Let's actually see how this builds across different stages of life. If your target is $1.5 million at age 65 and you're 25 years old today, you only need about $100,000 invested right now. That's it. At 35, you need $197,000. At 45, because you have way less runway, it jumps to $388,000. Handing time a massive head start radically shrinks your required starting amount. A dollar invested at 25 does decades of work. But a dollar invested at 55, it's basically an intern showing up on the last day asking where the coffee is. This right here proves exactly why everyone screams at you to start early. To put that into perspective, over a 40-year investing life, about 80% of your final balance is just pure growth. Only 20% is money you actually contributed. The first 10 years of investing, it's like you're shoving a stalled car. It is agonizing. But the last 10 years, you're just jogging alongside it as it rolls downhill, pretending you're still pushing.
Section 4. The Reality Check. The Trap of Averages.
Now, what's really interesting about this reality check
is the dangerous gap between median and average. We have to acknowledge a massive asterisk on this math, because reaching that crossover point is incredibly difficult. The median amount of retirement savings for an American household, the person right in the exact middle, is about $87,000. But you constantly hear the average is around $334,000, which makes it look like the typical person is nearing the crossover point. But averages get dragged wildly upward by a few extreme outliers at the top. The typical saver is actually nowhere near this solar system.
If you feel like your crossover number is 1,000 miles away, I really want you to hear this clearly. You are not failing. It's not because you buy too many lattes or lack discipline. It is a structural reality. Honestly, it's an income problem. Wages just haven't kept up, and the base cost of simply existing eats the margin that used to become savings. You literally cannot divide your contributions by 7% if there's nothing left to contribute.
Section 5. The trap and the risks.
But what about this sliver of people, the roughly 5% of households, who actually do reach the crossover? Well, they face a tragic irony. Studies show that retirees who enter retirement with over $500,000 spend down only about 12% of it after 20 years. Roughly a third actually get richer during the phase of life they were supposed to be spending it down. It's called one more year syndrome. These financial victors end up guarding a fortune they will statistically never spend. They hit their number, but instead of finding freedom, they just feel like the number needs to be bigger, sacrificing their most vibrant years in the process.
And to be fair, there is a real mathematical reason people are terrified to stop saving. Averages can be absolute liars over a short stretch. Look at the 2000s, often called the lost decade. Over that entire 10-year span, the market delivered a return of roughly -1% per year. If you decided in 1999 that you had hit your crossover point, trusted the average, and just quit saving, that decade would have flattened you. During stretches like that, your active contributions are literally the only thing keeping the ship moving.
Which brings us to sequence of returns risk and panic selling. A market crash right at the exact moment you retire can completely gut a portfolio that would have been totally fine if the crash just happened 10 years earlier. And worse, human behavior takes over. The market offers a historical return that your nervous system actively talks you out of, leading to panic selling at the absolute bottom. This is exactly why your personal savings rate, especially early on, is the only variable you fully control.
Section 6. Knowing when to live.
So, what does this all mean? How do we balance the reality of the math with the sheer unpredictability of life? Let's fast forward 30 years to age 65 to find out. Remember Alan and Maria? Alan, who essentially stopped adding money at 35 and just let the market do the work, retires with $3 million. Maria, who never stopped grinding, has $5.3 million. But look at the cost. Over those 3 decades, Maria personally shoveled in over $700,000 of her own money. Her entire 3-decade grind bought her an extra $2 million she will likely die holding, paid for with 30 years of life experiences she simply does not get back. Both of them made it, but only one of them noticed in time to actually enjoy it.
Which leaves us with this final thought. Your early saving years are absolutely crucial. They build the engine. But once that engine turns over, you have to recognize it. You've got to find your crossover point. And when you finally reach it, I leave you with this. Are you too busy saving for a life to actually live it? Have the nerve to act like you've won when the game is finally over. Thank you so much for joining me on this explainer, and we'll catch you next time.